Wall Street just drew a line in the sand for crypto. S&P Dow Jones Indices, the same people behind the S&P 500, just launched a major new benchmark with Pantera Capital. It includes 18 digital assets. Ethereum is the largest holding. But here's the twist that's sending shockwaves through the market. No Bitcoin, no XRP. The S&P Pantera Digital Asset Index only includes assets whose underlying protocols generate measurable revenue. It's applying a fundamentals-based framework to crypto, separating networks that actually produce economic value from those that are primarily price-driven or store-of-value plays. This isn't some random altcoin list. This is S&P bringing institutional discipline to digital assets. Today we're breaking down exactly what this index is, why Bitcoin and XRP were left out, what it means for Ethereum and the broader market, and whether this marks a turning point in how serious money views crypto. You are watching the Signal and Noise podcast. Make sure to like and subscribe as we analyze with no emotions or bias, just raw data analysis, pointing towards the signal and dispelling the noise. This is not financial advice. Do your own research. On July 21st, 2026, S&P Dow Jones Indices and Pantera Capital officially launched the S&P Pantera Digital Asset Index. It's designed as a rules-based benchmark for institutional investors who want structured, diversified exposure to digital assets, but with real guardrails. Key features: focuses on assets whose protocols generate measurable revenue. Approximately 18 constituents. Ethereum is the largest holding. Quarterly rebalancing. Screens for liquidity, listing standards, and market history. This is explicitly not a market cap weighted free-for-all. It's trying to do for crypto what traditional equity indices do: emphasize quality and real utility over pure speculation or narrative-driven assets. The methodology is clear: only protocols that generate measurable revenue make the cut. Bitcoin is the ultimate store of value and the largest digital asset by market cap. It has incredible security, adoption, and a fixed supply narrative. But in the strict sense used here, the Bitcoin protocol itself doesn't generate revenue that flows back to token holders in the same way many smart contract platforms do. BTC is often compared to digital gold. XRP has a different model focused on cross-border payments and utility. While it has real-world use cases, it doesn't fit the specific protocol revenue generation criteria applied in this index. This isn't a judgment on their long-term value. It's a deliberate design choice to create a benchmark for the productive blockchain economy, networks where the token has an economic role tied to actual usage and value creation. S&P and Pantera are bringing traditional finance-style fundamentals analysis to crypto. Ethereum tops the index for good reason. The Ethereum network generates substantial on-chain revenue through gas fees, staking rewards, and the broader ecosystem of DeFi, NFTs, and tokenized assets that run on it. ETH has a clear economic model where usage drives value accrual. Other likely constituents include major smart contract platforms and protocols with strong revenue profiles like BNB, SOL, and TRX. The index uses on-chain data, powered by sources like Artemis, to measure real economic output rather than just hype. This approach highlights a maturing view of crypto. Not everything is equal. Some assets function more like commodities or currencies. Others operate like revenue-generating infrastructure or businesses. By focusing on the latter, the index aims to provide a cleaner, more investable exposure. For institutions, this is potentially huge. Many traditional allocators have been hesitant about crypto because of volatility, lack of clear benchmarks, and difficulty separating signal from noise. A rules-based index from S&P gives them something familiar. It could accelerate capital flows into revenue-generating protocols and ecosystems. Projects and chains that can demonstrate real economic activity may see increased attention and investment. Quarterly rebalancing adds discipline. At the same time, this doesn't diminish Bitcoin's role. BTC remains the dominant asset and the gateway for new capital. This new benchmark complements existing exposure rather than replacing it. It's a tool for those seeking a more equity-like slice of the market. Not everyone will agree with the methodology. Critics may argue that Bitcoin's scarcity and security are its value proposition, even without traditional revenue. XRP's utility in payments has real economic impact that this framework might undervalue. Revenue metrics can be gamed. These are fair points. Crypto is still young. Pure monetary assets like BTC have proven incredibly resilient. The right argument is that S&P and Pantera are applying a consistent, transparent framework. This mirrors how traditional markets evolved from pure speculation to fundamentals-driven investing. It brings credibility and structure, which is exactly what institutions need. Like any new index, there are caveats. Revenue data in crypto relies on on-chain metrics, which can be interpreted differently. Liquidity screens are important, but markets can still be volatile. Regulatory clarity continues to evolve. Looking ahead, expect more benchmarks and more institutional products. Tokenization of real-world assets will likely interact with this trend. Revenue-generating protocols become even more attractive when they underpin tokenized economies. The separation of productive versus speculative assets will probably become more pronounced over time. S&P's new Pantera Digital Asset Index is a significant step. By excluding Bitcoin and XRP in favor of revenue-generating protocols, it applies traditional finance discipline to digital assets. It signals that fundamentals matter more than ever. The productive blockchain economy now has a major Wall Street stamp of approval. What do you think? Is this the beginning of a new era where revenue and usage trump narrative, or will Bitcoin's dominance keep broader indices dominant? Drop your thoughts in the comments. If you want more on institutional crypto adoption, subscribe and hit the bell. What do you want us to discuss next? Do you want us to delve into the Clarity Act in Solana, or the adoption of Chainlink by Wall Street? Tell us in the comments section. Remember, this is not financial advice. Make sure to do your own research. This is signal and noise. Wall Street is getting serious about crypto, and the rules are starting to look familiar. Stay sharp. Stay curious.